Hello and welcome to Finance Conversations. This is the 42nd episode of the Merging Life and Money Show, and I am super excited to be here today. For those of you who do not know me, I am your host, Marie-Jo César. I help professional women bridging the gap between life and money by acquiring and applying the relevant skills and knowledge they need to take control of their money, manage their finances, and understand that they can live their best life with the money they have. Thank you for joining in today. If you are watching the replay, make sure to type #replay in the chat and leave me some comments and questions. Welcome, welcome, and welcome. I come to you live every Thursday at 5 p.m. Pacific Standard Time to share valuable information about how to achieve financial wellness and live your life with means and meaning. Today, my guest, Eric Dudley, and I will be talking about a simple yet rewarding investment approach called the three-fund portfolio. Eric Dudley, my guest, is an experienced holistic financial advisor and an independent financial advisor as well, specializing in retirement planning, investing solution, and life insurance. He is a founder and president of Dudley Financial Group, and one of Dudley's Financial Group's main goal is to help their clients build their best tomorrow while protecting them today. Welcome, Eric, to the Merging Life and Money Show, and welcome, followers and listeners. Thanks for joining in today. So grab a pen and a notebook, as you might want to take some notes today and discuss them and share them further with family members, friends, and colleagues. Remember, it's all about sharing values that could benefit others. So if you have any questions or comments, make sure to put them in the chat. And as I mentioned a few moments ago, we will be looking at an investment strategy called the three-fund portfolio. So if you want an uncomplicate investing, a three-fund portfolio approach can be a simple way to grow wealth over time. So tell me, Eric, what is a three-fund portfolio?
Well, thanks for having me today. A three-fund portfolio is a very basic way to start investing for beginners. It's simple, but it can be powerful because it will allow you to be able to diversify and be able to invest in several different things to give you some protection just in case the markets go in a different direction.
Okay, so you said that it's made of various components.
Mm-hmm.
Yeah, could you tell us more about those components?
Yes, there's three components to it. The first one is going to be U.S. stocks. The second one is going to be U.S. bonds, and the third one is going to be international funds, which will be equities or stocks. By doing that, if things are not going as well in the U.S. markets, you will have international funds that will help you. If both of the equities are not doing well, usually the bonds will pick up. And so that way you have diversity. Now, when I say stocks, I don't mean, just one individual stock.
Okay.
You don't want to go out and just say, oh, well, I really like Nike shoes, and so I'm going to get Nike and that'll cover my U.S. stocks.
Mm-hmm.
No, we are talking about an investment fund, which is called an indexed fund.
Okay.
Now, what is an index?
Yeah, I was just about to ask you.
Right.
You're using some words that my audience may not be familiar with.
Right.
So today, right now would be a good opportunity for you to tell them a little bit more, because I am urging my followers to take the rest of the year to reflect on what they have done for 2021 and turn a leaf or get a new book altogether for 2022. So investing is one thing that I urge them to take a look at, and it is quite timely that you are you have decided to talk about this very simple investment approach. So tell us more about index funds.
Okay. Well, index fund, if you've ever watched any business show, they will talk about how the stock market's doing each day, and they will give you certain names like the S&P 500, the Dow, the Nasdaq,
Right.
the Russell 2000. Each one of those are index funds. It means that there's a group of stocks that are all involved in that company. For instance, with the S&P 500, there are 500 companies that are involved in that. The Russell 2000, there are 2,000 different companies that are all invested in that fund. Each one of them have their own specific genre. For instance, with the Dow Jones, there's 30 companies, and they're basically really large companies that you've heard about for generations. If you go to the Nasdaq, for instance, it's almost all technical stocks.
Mm-hmm.
So it's all of the new tech stocks that have been around for the last, 25, 35 years, something like that, that would all be
Mm-hmm.
on there. The Russell 2000 would be smaller companies, whereas the S&P 500 would be more larger companies, well, at least mid-sized companies. So they all have their own little, a niche for types of companies that they have, but they're all indexes. So that means if one company does really badly, that doesn't mean it's going to sink your whole ship, because they have a lot of other companies to keep it up.
So, is that what you would call asset allocation?
Well, the asset allocation would be the stocks that we're having here. And then
Okay.
we're going to go to also to bonds, which is also a different allocation. So the same thing is true about bonds. We're going to get into an index fund for bonds. And then we'll do the same thing for our international stocks. So by doing that, you have now three different types of asset allocations. You
Mhm.
have US stocks, US bonds, and international funds.
So basically, what you're saying to me. So are they when you do such when you use such an approach or such a model? Do you use mutual fund or do you use stocks?
Well, you can use mutual funds to be able to get into them. What I would suggest, and I was going to talk about this later, but that's fine.
Okay.
What you just go to different sites. You can use TD Ameritrade or Vanguard or
Okay, let us not
whoever.
let us not get into it right now because I don't want to break your flow there. It's
Okay.
just that when we talk about the stocks and the bonds,
Mhm.
it's this thing called diversification and this thing called also asset allocation, which is the backbone, if you will, of investing.
Mhm.
Because that's how the money is made, by
Mhm.
having a proper relevant asset allocation. So now that you mention the fact that index funds are used, so tell me, what are the benefits of this type of investment strategy?
Well, one of them is, of course, you're trying to one of the biggest things about investing is that you don't want to go into an investment and thinking I might lose it all. Okay, you want to feel like, hey, if one stock does badly, then you're not going to go down the drain. And so, by having indexed funds, you know that there are losses in the portfolio. Then there are gains because some companies will do really well and other companies might do poorly. Now, this is not a super aggressive way of investing. I think a lot of times young people today are hearing these astronomical returns that you get from things like cryptocurrency and things like that, and they think, well, that's just the norm. It's not the norm, and anytime that you have a investment that can go up by 60% in 6 months, it can go down by 60% in 6 months too. So index funds are much more conservative. They will consistently, historically speaking, go up slowly, then have drawdowns, and then they'll go back up. Because the companies, of course, are reaching new plateaus all the time. And one of the other things about index funds is that they do give you natural diversification because of that. You have so many companies allotted there that you can protect yourself. So you do have a chance to make good returns, solid returns, not flashy or sexy returns, but solid returns, and you give yourself some downside protection, which is really important. Another thing about index funds is it's extremely low cost to get into. That's one of the things a lot
Yeah,
of do-it-yourself.
this was going to be my next question to you, because when you talk about all these funds and these stocks, and people may think that, okay, how much is this going to cost me?
Yeah.
So tell us more about the cost of investing or having such a portfolio.
Well, okay. For instance, if you were to ask a financial advisor to manage your fund, you might pay a 1% fee. That's a pretty standard 1% fee for people to manage your portfolio. Now, if you do it yourself and you do it through, for instance, Vanguard, which is extremely inexpensive, you might pay a 0.03 expense fee, which means you're saving 97% on the fee. It's a fantastic savings, and to be able to actually be in these index funds, be able to see some good results, and pay almost nothing, because you're doing the work and you don't want to pay too much for it.
Yeah. And great. So it is easy. You could easily access those funds, from what I hear, or stock, whatever you decide to put in that portfolio. And not only that, but they are also very cost effective. So tell me about um, how do you follow? Because when you start your portfolio, you would start with a certain percentage in a certain type of asset. Let's say, a percent of in a stock, a percent in bonds, and you mentioned international stocks as well. So, and a portion in that, if you wanted to, right? So let me make sure that people understand that we're talking about U.S. in particular, U.S. bond and U.S. Equities, and a third leg, which will be international stock of funds, right? So how do you maintain? Because with the fluctuation of the market, let's say I started with 40% of equity in my portfolio. With the ups and downs, that 40% is not static. So can you explain to the audience what they ought to do to remain in the initial asset allocation that they chose?
Okay. Yeah, that's a very good question. Well, basically, there's three aspects to figuring out how you're going to divide those three portions out. There's age, there's time, and there's risk tolerance. Okay. So age, how old a person is. If a person is in their mid 20s, they have time to ride out some bad times in the stock market. If you were 23 years old in 2007, you were not really that worried about the whole stock market going down. Okay. Because you know what? The stock market goes down. I don't have a ton of money in the market. And guess what? Right after the stock market went down, it's gone up for 13 straight years. So if you were consistent and just never pulled the money out, then you've made a pretty good return.
Yeah.
If, on the other hand, a person was 65 years old, and in the same situation, they might have a lot of money in those funds. They might actually be drawing out the money for their retirement. They don't want to see their stock market portfolio cut in half during that time. It will scare them to death. it might wind up giving them a health issue.
Yeah.
so there's a big difference between age and, of course, time means basically a similar thing. How much time do you have until you want to start using the money? So if you're 45 and you think that you want to retire when you're 60, well, you have 15 years. If you're, let's just say, 50, but you don't think you want to retire until you're 75, well, okay, you've got 25 years. Okay. So you're considering how many years until retirement you want to be able to invest. Okay. And that's invest without pulling out money.
Right.
And then, of course, the third one is risk tolerance. Everybody is different. Okay. Some people can live with a little more, of the roller coaster action that happens when investing, and they're totally fine with it. They don't get anxiety about it. They don't have to check it every day. They just trust and believe, and then they're okay. Other people, well, it might cause them a lot of sleepless nights.
Right.
So you have to know who you are as well. And there's all sorts of risk tolerance questions that can be asked, and if you answer them correctly and honestly, then you'll be able to figure out exactly where you fall in that. Um,
Okay.
okay,
So
well, go ahead.
before you get too far with that, I just want to recap as we speak. So basically, what you're saying is that in order to build your portfolio, there are some key elements that you must take into consideration. Your time horizon and retirement. In this case, you'll be if that's what you're looking at, you'll be looking at your time horizon to retirement.
Mhm.
So this will indicate your age clearly, and it's not because that you are retired or about to retire that you would totally remove, let's say, equity out of your portfolio.
Mhm.
Again, it is going to be based on your current lifestyle, your plans for the future, I assume, and how much longer you are prepared to tolerate the ups and downs of the market. And I always tell people, like, don't get into it if you're going to get palpitation of the heart,
Yes.
because you may not live to see to benefit, the highs of the market when it did happen. So that's really good to know. So there are a few little rules, and understanding. Once people educate themselves, they would totally understand that it is not as complicated as it appears. So now that you basically, that's something you explained, that is a portfolio that you build. So how much stocks to bonds do you have to have? And I know it's no magic formula, since you just explained that a lot of it is based on individuals,
Here,
the time horizon, etc., etc. However, is there anything that you could tell us about? Is it the ratio bond to stocks that one must have in their portfolio?
well, that's a good question, and a general rule of thumb, it would be that you take the number 110 and you subtract your age from 110. So if a person is 30, you subtract 30 from 110, that leaves you 80. And that is how much stock you should have, as opposed to 20% bonds for your portfolio. Now, if the person was 50, then you subtract it from 110, and that would leave you with 60% for stocks. And then, of course, the rest would be in bonds, 60/40.
Mhm.
Now, this can be changed. If a person is more aggressive according to their risk portfolio, you might want to
Mhm.
say, hey, I'm 50, but you know what? I am okay with a little more risk and I want some more returns. So, since stocks usually give you better returns, you might say, okay, I'm not going to go 60/40. I'm instead going to go 70/30, 75/25. It's up to you, okay? Because everybody's different. But that 110 minus your age is just a general place to kind of start from.
Okay. Well, that's good to know that there could be some very loose guidelines there, and so I almost wanted to laugh and say, well, if you're 110, don't worry about it.
That's right.
Don't worry about having any stocks in your portfolio, right?
Right.
Yeah, so good. So now that you explain what makes up that portfolio, the three fund portfolio, could you tell us a little bit about where we can go to purchase those funds?
One of the great things about living today, I mean, it really is amazing. You can go on so many platforms and be able to pick out these funds just so easily. Every one of them, whether it's Fidelity or Vanguard or wherever you go, they will have an index fund that they have designated at that site. Okay, for instance, with Vanguard, they're gonna have an S&P 500 fund, and all that means is that whatever the S&P 500 does that day, if it goes up 2%, then your fund went up 2%. If it goes down 3%, then your fund went down 3%. Okay, I mean it is completely correlated exactly to whatever the index does. And so you can find those funds easily. It's, as a matter of fact, one of the first ones they show you. Okay. And it's extremely, at Vanguard, extremely popular to use the NASDAQ ones, the S&P 500 ones, the Russell 2000 ones. They're very popular. And the same thing can be said for bonds. Okay. You can go into whatever bonds you want to purchase and be able to get an index fund for your bonds in the same way. And then with international funds, the same way. You just go into these platforms, and it's one of the first things that you'll see. And they'll just say the index funds are right there. It'll have a small ticker sign of what you'll be able to actually say. And you just put in the percentage that you've already decided for, and it'll make your a 3-fund portfolio pretty quickly.
Okay. So that is very, very good information here. I just want to ask one question. A lot is being spoken about cryptocurrency. Okay, so would cryptocurrency even feature in a 3-fund portfolio?
Well, I think that cryptocurrency has a lot of potential, and I'm not going to say something bad about it, okay? Because too many people are making a lot of money from it. But it also would scare me to death if that was the part of your retirement plan, because you don't know where it's going to go. It could go way, way up, or it could go to absolute zero. There are countries that are actually wanting to ban it. So what I would say with cryptocurrency is this: if you have an extra 5% of your income that you just say, you know what, I don't need this. It's not something. If I lost it all, I wouldn't be that concerned about it. And then put it on cryptocurrency or whatever speculative investment you believe in. And if you did lose it all, just understand, sure, you lost a little bit of money, but you were thinking that you might hit a home run, and that might be worth it. Who knows? You might hit a home run. So that's the way I would look at it. I would definitely stick with the more conservative plans for your actual retirement, because you don't want to be one of these people who are hoping to hit the lotto to be able to retire someday.
Right. So basically what I'm hearing is, unless you are prepared to lose that disposable income, do not use it on crypto.
I just would be really careful, just
okay.
Make sure you're willing to lose the money.
Yeah, that's good information, because sometimes, it's a whole effect of not putting all your eggs in one basket. And, by doing the 3-fund portfolio, you're doing right by understanding what you should be doing in an easy fashion. And we're talking about do it yourself. So, and I always tell people, give yourself a gift and, learn the basics of investing, because it is not rocket science. It's a matter of understanding how this works. And you don't need to, get involved in the esoteric type of investment options, like commodities and hedge funds and crypto, things of the like. And you could start a little bit at a time, educate yourself, and apply what we just discussed. So, which is a good segue for me to just do a quick recap of what we discussed we've been discussing over the past 25 minutes. It's about the 3-fund portfolio, which is a very simple and rewarding investment strategy so Eric explained what it is made of, and the main what you should consider when you decide to you decide to get involved in the 3-fund portfolio. And he explained the benefit of this type of investing. And he also talked about how to build such a portfolio. So before I forget, Eric, thank you very much for the show today. And could you tell the audience how they can contact you? So I have your information, so I'm going to show it as well. So if you could just tell them, I don't think I have your phone number on there, but you may want to do that.
My phone number is at my website, dudleyfinancialgroup.com. You can set up an appointment with me in the upper left-hand corner, or you can just put the contact information in there and I will contact you. And my phone number is at the website, like I said. So you can contact me through there, or I'm also on LinkedIn.
Great. And thank you, Eric, for your awesome contribution to the show today. We will meet again next year, that is, with another great topic. And our date for next month would be the 20th of January, 2022. So hopefully the audience would have taken a look at this show today and start building their 3-fund portfolio. Thank you, Eric. Happy holidays to you and yours. And it's a pleasure to be associated with you.
Thanks, MJ.
And Happy New Year as well when it gets there.
Thank you too, MJ.
Okay. For more information about how to achieve financial wellness from the inside out and live a purposeful life with the money you have, join me next week, Thursday at 5 p.m. Pacific Time, 6 p.m. Mountain Time, 8 p.m. Eastern Time, 9 p.m. Atlantic Time for my Bermuda Pips, 10 a.m. Friday, Brisbane, Australia time for my Australian friends. Thank you for being here today on the Merging Life and Money Show. I am your host, Marie-Jo César. I will be back again next week. Until then, continue merging life and money. Bye for now.